Let's talk about corporate actions. They're kind of like the secret language of the stock market. These behind-the-scenes moves that companies make that can have a huge impact on your portfolio. And honestly, understanding them isn't just nice to know, it's absolutely crucial for any investor.
So, picture this. You open your portfolio and your stomach just drops. One of your favorite stocks is down. It's so easy to panic, right? But what if I told you that price drop isn't actually bad news? What if it was a totally planned event by the company itself? Well, let's dive in and find out.
So what in the world is a corporate action? Well, to put it simply, it's any big decision a company makes, something that gets approved by its board and its shareholders that really changes things for its stock. You should think of it as a scheduled event, not just some random noise in the market.
Okay, so we know what they are. Now, here's what we're going to cover. First, we'll get into dividends. That's how companies pay you cash. Then we'll look at bonus issues and splits, which is how you can end up with more shares. We're also going to explore rights issues. Think of it as your own exclusive chance to invest more. And finally, buybacks, what it means when a company decides to bet on itself.
All right, first up, probably the most common corporate action out there, dividends. This is when a company takes a piece of its profits and shares it directly with you, the shareholder. It's basically a cash reward just for being an investor.
A dividend really makes your investment feel real. It's actual cash, like this amount right here, just showing up in your bank account, all because you own a small piece of that company. Let me show you how it works.
Let's take a real-world example. Not too long ago, Infosys declared a dividend of 42 rupees for every share. So, if you owned 100 shares of Infosys, you would have gotten 100 times 42, which is 4,200 rupees. And that money gets sent right to the bank account and you've linked to your investment account. It's as simple as that.
Now, actually getting that dividend is all about timing. The company sets a record date to check who's on the official shareholder list. But honestly, the only date that really matters to you as an investor is the X date. You absolutely must own the stock the day before the X date to get that dividend. If you buy it on the X date or after, that money goes to the person who sold it to you. Get it right, and the cash hits your account on the payout date.
And this brings us to a really crucial point about that X date, something that trips a lot of people up. The stock price will almost always drop by roughly the amount of the dividend. This is not a market crash. It's just simple math. That cash has moved from the company's value over to your pocket. So if a stock is trading at 335 and pays out a 15 rupee dividend, it's completely normal for it to open the next day around 320.
Okay, next up, let's talk about two corporate actions that sound like an absolute dream come true. Getting more shares for free. We're talking about bonus issues and stock splits.
So with a bonus issue, the company just gives you extra shares. Let's say it's a 1-for-1 bonus. If you have 100 shares, boom, you get another 100. But, and this is a big but, the share price gets cut in half. So as you can see, you now have 200 shares, but the total value of your investment is exactly the same. You have more shares, sure, but you aren't any richer.
A stock split works in a very similar way. A 1-for-2 split just means your one share now becomes two. So again, if you had 100 shares trading at 900 rupees, your holding turns into 200 shares trading at 450 rupees each. Your total investment value still unchanged at 90,000 rupees. It's kind of like cutting a pizza into more slices. You have more pieces, but you still have the exact same amount of pizza. So if the outcome is basically the same, you're probably wondering, what's the actual difference between them? Well, it all comes down to a really technical accounting term called face value. With a bonus issue, the face value of each share doesn't change. With a stock split, the face value gets divided up right along with the price. For most of us, this doesn't really have a practical impact, but that's the official line that separates the two.
So why even bother with splits or bonuses if your wealth doesn't actually change? Well, it's all about one word: accessibility. A single share of a company like MRF can cost 90,000 rupees. That's a massive barrier, both financially and just psychologically for most people. By splitting the stock, the company makes that price tag smaller, which invites more everyday investors to come in and just generally gets more shares trading on a daily basis.
Okay, our next action, a rights issue, completely flips the script. So far, we've talked about the company giving things to you. Well, now they're asking you for more money. But the clever about it, they frame it as an exclusive opportunity just for their existing shareholders.
This is a really great way to think about it. It really is like an initial public offering, but it's only open to the company's current fan club.
It's shareholders. You get the first right to buy new shares, and it's usually to fund something new, like a big project or an expansion. So the offer usually comes with a nice little discount. For instance, a company might offer a 1-for-4 rights issue. That means for every 4 shares you already own, you have the right to buy 1 more. And hey, if the market price is sitting at 500 rupees, they might offer it to you for just 400. On the surface, it seems like a no-brainer.
But hold on. Before you jump at that discount, you have to pause. You need to ask the big question. Why does the company need more cash? Is it for some exciting new growth plan, or are they maybe trying to cover up some problems? That discount looks tempting for sure, but it's completely worthless if the stock price itself ends up falling below the offer price. If that happens, you'd actually be better off just buying the shares on the open market.
Our final corporate action is the buyback. This one's a big deal. It's when a company takes its own profits and uses them to buy its own shares back from the market. It's a really powerful move, and it's often seen as the ultimate vote of confidence from the people who know the business best, its own leadership.
A buyback sends out so many powerful messages. See, by reducing the number of shares out there, it automatically makes metrics like earnings per share look better. It also tightens the ownership of the main promoters, it can help fight off hostile takeovers, and maybe most importantly, it screams that the management believes their own stock is a bargain. It's basically them saying, we think our shares are the best investment we can possibly make right now.
All right, we have covered a lot of ground. So let's boil it all down to the key things you need to remember as an investor.
Okay, here's your quick field guide. You see a dividend? Think cash rewards. But always check that X date. A bonus or a split? Don't get carried away thinking you're suddenly richer. It's all about making the stock more accessible. You see a rights issue? Treat that as an invitation to do your homework, not just a deal to accept. And a buyback? See that as a really strong signal that the company's insiders are feeling very good about their own future.
So the next time you see one of your stocks make a sudden move, don't just react. Take a breath and ask yourself, could this be a corporate action at play? Because now you have the tools to actually understand the story happening behind the numbers.